Interesting time. We've actually seen Chinese equities lagging the rest of Asia this year, doing worse compared to emerging Asia as well. Is that going to change in the second half? And if so, what brings the stocks back up into what its peers are doing?
Yeah, Rhonda, one of the interesting aspects is we all look at year-to-date numbers. And what investors haven't noticed is since March, Chinese equities have actually rallied very strongly off the lows. While the year-to-date numbers are still negative, they're actually getting in very far off the lows, and we think that trend could lead to a much better second half of the year.
Why? What's driving it?
I think the Chinese government is very much focused on getting the economy stabilized. They're introducing a number of stimulus plans, which we think the market is beginning to wake up to, and it's starting to be reflective in a nice upward movement.
So let's talk about some of your ETFs, including the 5-year plan fund, which I believe you're making reference to here. Heavily invested in tech and consumer names. How is the government's policy benefiting those sectors in particular? Yeah,
I think first and foremost, one thing investors should realize is within the last year, the disparity between the best and the worst performing sector in China is actually over 70%. Over the last 5 years, that disparity grows to over 375%. So where you've invested in China has really determined your results. And our view is with the 5-year plan is the government has said that they want to upgrade the technology and telecommunications area with 4G and subsequently 3G. So we're seeing a great movement in terms of the technology from the government support, and we think that trend is very much going to continue, much like domestic consumption. Recently, the Chinese government cut their VAT tax for a wide variety of different companies to try to get that consumer spending up. In June, consumer spending was up 12% year over year, a very, very strong number coming out of China.